Real estate in general and REITs in particular are thought to be interest rate sensitive by most investors. What do you think about the risks of REIT investing in today's rate environment?
Sure. I think that all investments are interest rate sensitive at some level, right? Real estate, along with industrials, et cetera, REITs in particular, tend to get a lot of focus because they are forward-leading and forward-looking relative to private real estate, which only gets appraised on a quarterly or perhaps annual or semi-annual basis. So REITs get that focus, and I think in the last couple of years, looking at the REIT movement, what you've seen is REITs sell off in anticipation at times of Fed tightening. And I think the concern that folks have is that an increase at the short end of the curve may end up impacting the long end of the curve. Okay, so that's the sentiment that exists, right? So when Fed policy looks like it's going to tighten, REITs look like they're going to basically be selling off. The facts are, however, if you go back to 1999 through today and you look at how REITs have performed in the 3 months after central bank tightening, REITs have outperformed not only on an absolute basis, but they've outperformed broader equities in the 3 months following a central bank raising. And what this reveals to us is that REITs and real estate aren't just interest rate sensitive, they're basically economic sensitive. REITs and real estate are lagging indicators. The better the economy does, the more likely there will be positive absorption in a particular market. So I think the positive returns that we see going back to 1999 reflect the fact that there's more to the story than just interest rates increasing at the short end of the curve. There's really a question of, is that increase consistent with economic growth? And equally important, what happens on the long end of the curve? So when the 10-year Treasury rate moves up, I would expect that long-term investments tend to perform less well. Now, the question I think that exists at this moment in time in October 2015 is what will happen as Janet Yellen increases interest rates on the short end of the curve to the long end of the curve, namely the 10-year Treasury rate. And I think that the common wisdom today is that rates would, on the 10-year, move up consistently and parallel with a short end increase at the Fed funds rate. However, it is possible and potentially likely that an increase in the Fed funds rate may be seen as a policy mistake, and a policy mistake given weakness in growth in other parts of the world. And therefore, the 10-year Treasury rate may end up, or the 10-year Treasury bonds may end up rallying, 10-year Treasury rates moving down in the face of an actual Fed tightening. So that's a complicated story. And I think the best way to think of it is that there are really 3 drivers of real estate. And this is, no matter how complicated things get, we try to break things down into these 3 consistent buckets. The first is the fundamental bucket: supply, demand, occupancy, rental rate, cash flow. That's an easy bucket. The second is capital market bucket. Basically, how does debt and equity priced, namely equity and credit spreads. And the third is basically government policy. Government policy includes fiscal, regulatory, and monetary policy. In those 3 buckets, interest rates at the short end of the curve are only in one of those buckets, and it really only represents a portion of the overall equation as to how real estate gets priced and the way that investors feel about REITs and real estate as an investment. So I think that you can get a lot of this wrong. And what we see today, not to go too long on your question, but what we're seeing is a lot of investors blinded to risk and to opportunity because of their short-term focus on the Fed action. All right, how are they blinded to risk? They're blinded to risk because over an extended period of time where interest rates stay low, as they have for the last 6 years, and perhaps they will for an extended period of time, this may end up causing an unintended consequence. And the unintended consequence that we're paying attention to is, what does this mean for development? The first wave of development that we're seeing in 2015 and 16, and maybe even into 17, is demand and supply of buildings where we think that there will actually be good demand for those particular buildings. However, if interest rates stay low, we think that the credit markets will ultimately lend into construction, and that you'll see more developers lining up to build assets and to build properties in particular markets. And you only need to look at the Boston apartment market or the Washington, D.C. apartment market or everything in San Francisco right now to see what it means when you're basically adding new supply. So we worry about basically a year 4 to 5 risk of interest rates staying low, and that actually causing a supply shock as developers are all thinking at the same time that they can deliver properties at a spread to what investors would be willing to pay. So long story short, but remember the 3 buckets.
In the U.S. private real estate market, Center Square has taken the position that primary market core assets are overpriced at the moment. Where do you see the best combination of pricing and growth potential?
Sure. We're a relative price buyer, right? So we want to look at relative price. And I think that the comment there is really that relative to core gateway city assets that are owned in the private markets, we can acquire those investments in the public REIT market at a meaningful discount to private real estate valuations. So were I a portfolio manager running a large institutional pool of capital, I would certainly want to have exposure to core real estate, but if I could buy it today, I would prefer to buy it less expensively and at a discount, and I can do that in the public REIT market today. That's kind of one thing, is relative price. The second thing is really simple bond math. And the way the bond math works is that we talked about interest rates and the potential for the long end of the curve to move up. If the long end of the curve does move up, then we would expect those assets that have the lowest cap rates, when a 100 basis point move from 4 to 5% is much more damaging to asset value than a move from 6 to 7%. And so the simple bond math makes those gateway city core assets potentially more at risk in an environment where interest rates move up. So we're concerned about it from that perspective. And look, at the end of the day, if you just simply look at it based on flow of capital, you've seen tremendous flow of capital into those assets. And we think that there is some better strategies and some better relative pricing if you look where investors are not all crowded at the door to get in.